And we're going to do Facebook too. Okay, cool. Awesome. So, and I'm going to go ahead and start the recording as well. We're going to do Facebook too. Okay, cool. Hold on. Okay, sorry, tech glitch, but I think we're good. Welcome everyone to our March workshop for the Badass Moneymakers. So our topic for March is taxes and virtual currency. Virtual currency is a very hot topic right now. And so I thought this would be a good one to talk about this month because I've been getting a ton of questions about how to handle all of the Bitcoin and crypto and NFTs and everything that folks are starting to dabble in. And the tax on this is very confusing. So I thought we would do this. We're going to get started. Let me know as we go through if you've got any questions for me. But before we do get started, just a few disclaimers for folks who are here. You probably already know this. I am a certified public accountant or a CPA, but I am not necessarily your CPA. For some of you, I am, but for some of you, I am not, which means I don't represent you. And therefore, I'm not giving you tax advice today. I'm just giving you educational and informational advice education and informational information today, not advice. So if you have any questions at all, please consult with your accountant. If I'm your accountant, we can talk about your specific situation separately, and I can give you advice there. Once again, this is also not investment advice. I am not a financial advisor. I'm not an investment advisor. So I'm not telling you to invest in any kind of virtual currency. This is only giving you information on the tax guidance on what to do if you've already decided to invest in any kind of virtual currency. So I don't know about you, but I feel really confused when we start talking about virtual currency. I am not old school about most things. But when it comes to currency, I am used to dollars and cents, and that makes sense to me because I can see them, I can hold them in my hands. And when people start talking about like Bitcoin and crypto and NFTs, I get a little confused. So today we are going to be talking about those types of things, and we're going to be talking about what they are and what we do when it comes to taxes if we are investing in them. Because if you're like me, maybe a friend invested in them or someone told you about them and you're like, well, let me start dabbling in this. Let me see what's going on. And so you might have some money invested, but you might not have any clue what it's really invested in or what you're really doing. That's definitely how I feel when it comes to this stuff. So we're going to just take a step back and talk a little bit about what this stuff is in the first place, in case you're like me and it still feels a little overwhelming. So the world of digital currency or virtual currency, we can call them interchangeably. What is it? Well, first and foremost, it exists only in electronic form, digitally or virtually. There's nothing tangible that we can hold when we own digital or virtual currency. Generally, this type of currency doesn't require an intermediary. So for example, we've got our banking system here in the US. They are the intermediary for the exchange of dollars and cents. They are the intermediary for, we've got the stock market, which is the intermediary for the exchange of shares. Virtual currency usually doesn't have an intermediary like that. It can also be centralized or decentralized. In fact, one of the supposed benefits of virtual currency is that it's not centralized. And so people really like the fact that it has fewer regulations along with it, unlike the stock market, for example. It's often the cheapest method for trading currencies because of the fact that it's not regulated, it's not centralized. But because of that, it can be volatile to trade. It's also susceptible to hackers. So it's not as stable as something like the stock market, for example. So a lot of times when I start talking about virtual currency or digital currency, people are like, okay, so we're talking about crypto, right? And cryptocurrency is one form of virtual currency, but it's not the only form. So I just want to define a couple of things here. So when we talk about cryptocurrency, we're talking about currency that uses what's called cryptography to secure and verify transactions. Examples or popular examples would be like Bitcoin or Ethereum. And crypto may or may not be regulated. So there are a lot of options there. When we talk about virtual currency, we're typically talking about something that is controlled by the developers or controlled by what's called a defined network protocol. And I am not a tech person, so that is about all the information I'm going to give you on that. But it's, you can, there's lots of information about it online if you want to geek out on the tech stuff behind that. Virtual currency tends to be unregulated. And so, again, that's a lot of people see that as a positive of it, but it also makes it more likely to be unstable. We also have central bank digital currencies. And so these are issued by the central bank of a country. These are regulated because they're done through a country's central bank. And this is a fairly new concept, but it's, I think we've started to see some countries introduce their own digital currencies through their central banks, and I think we're going to see more in the next few years. So England, Sweden, and Uruguay are considering launching their own central bank digital currencies as just some examples. Okay, so let's get into some of the terms, because I always find it helpful when we're going to name drop a lot of stuff to just make sure we understand what all the different terms are. So Bitcoin is the first and pretty much most valuable cryptocurrency that exists. It was launched, believe it or not, back in 2009. So it's been around for a while. Its value has climbed quite a bit since then, but it also has seen really wild fluctuations. So just in the past few months, Bitcoin has gone from a record high of $60,000 to below $30,000. So when we're talking about, yeah, it's great that these are unregulated, this is some of that downside, which is they can be very unstable because they're very volatile markets. We also have something called altcoin. Altcoin is any type of cryptocurrency that's not Bitcoin. So an example would be Ethereum, which is pretty popular. Ethereum is the second most popular type of coin. But we also, other examples of altcoin would be any of the other thousands of coins that have very minimal market value. So cryptocurrency doesn't have to be something that has huge amounts of value. We think about like Bitcoin and we think about these big numbers. It's not always the case. You can buy Bitcoin, or you can buy coin that's has a lot lower value. Experts tend to say, and I remember I said, I'm not giving financial advice, I'm not giving investment advice here, but I did see this on an investment guide, and I thought I would share with you that experts say you should largely stick to the bigger, more mainstream cryptocurrencies when you're starting to invest. And I think that makes sense. You want to stick to the things that are a bit more known, that we have more history on to understand, before you start to dive into the things that are more volatile or more newer to the market and don't have as much history. So if you want to sound like you know what you're talking about, which I generally feel like I don't know what I'm talking about when it comes to all of this virtual currency stuff, but if you want to sound like you do, you can throw out the term HODL. So HODL stands for hold on for dear life, which is not just a funny phrase. It's actually a passive investment strategy where people will buy and hold onto their cryptocurrency instead of trading it in the hopes that it increases in value. This is kind of like what we do in the stock market with buy and hold, where we buy a stock and we'll hold it for 5 or 10 years, anticipating that it'll go up in value. But the difference is with crypto, it's much more of a crapshoot, right? We don't know. Remember, the markets are more volatile here. So we're just not sure what's going to happen. And that's why it's called hold on for dear life. I just want to pause there real fast and remind folks that if you have any questions at all, feel free to put them in the chat. I'm happy to address these as I go along, but we've got a lot of information to go through. So otherwise, I'm just going to keep trucking along here unless y'all have questions for me. I also want to throw out the term hard fork. So the hard fork is what's known as a radical change to a network's protocol that makes previously invalid blocks and transactions valid, or vice versa. So this definition comes straight from Investopedia, and it's a good one to be aware of because this does happen quite a bit in the whole virtual currency world. Again, I'm not a tech person, so that's about as deep as I can explain that one to you, but feel free to geek out on that on your own time. We also have in the digital currency world something called NFTs. So NFTs, or non-fungible tokens, are units of value that represent the ownership of unique digital items like art or collectibles. For example, I know that a lot of the pop stars, rock stars are doing this, where they'll have either pictures of themselves or artwork made of themselves, and they'll sell it, and it'll be sold through the use of NFTs to purchase it. So NFTs are most often held, at least at this point, on the Ethereum blockchain. This is a much newer thing in the digital currency world, but I think it's, it feels like it's exploding right now. Everybody's on TikTok talking about it. Everybody, it's a very, very popular thing. So I think we're going to see a lot more NFTs going around. And I've used this term blockchain a couple of times, so I thought I'd probably define this for you in case you're confused. So a blockchain is a distributed database that is shared among the nodes of a computer network. And if that made your head hurt, it made my head hurt writing it. Again, I'm not going to get into the tech stuff here. That's not what we're talking about. We're talking about tax today. But I just, wanted to throw out some of these terms. So, because I know at least when I start to read about this, I get really confused. Okay, so now that we've kind of done the quick 101 on what virtual or digital currency is, what does the IRS actually say about digital or virtual currency? So the IRS defines virtual currency as a digital representation of value that is not a representation of US or foreign currency and that functions as a medium of exchange. I wrote this here on the slide because it's true. That is actually probably the clearest thing I've ever seen the IRS say. And it's still not the clearest way that they could have written it, but it's at least reasonably understandable. So basically the IRS says that virtual currency is essentially a digital representation of value that isn't US dollars, that isn't foreign currency, and that is used to make an exchange I'm going to give you this and I'm going to get something in return. That makes it sound a whole lot like currency, right? However, that's not exactly how the IRS wants you to treat your digital currency. So they go on to say that convertible virtual currency is virtual currency that has an equivalent value in real currency or acts as a substitute for real currency. But again, they don't actually want you to treat your digital currency as currency. And I'll explain why in a second. Or I won't explain why, but I'll explain what that means in a second. So when we think about currency, if you have currency and if you just own currency, you don't pay tax just owing currency. If you exchange that currency, so if I have an investment of US dollars and I exchange it for some other kind of currency, if there's a gain on that, then I would recognize a foreign exchange gain. But the IRS doesn't want you to actually treat it like that. They want you to actually treat virtual currency like property. And we're going to talk about that a little bit. But I wanted to go through a little bit of the history of what the heck the IRS has actually done in this space. And remember I said that Bitcoin started in 2009. The IRS didn't say anything on virtual currency until 2014. So it took them 5 whole years to just come out and say anything about how we should handle virtual currency transactions. So in 2014, they said that virtual currency is not currency. It instead should be treated as property for federal income tax purposes. That's what I was just explaining there. And we're going to talk about what that means when we treat it as property in a second, but just remember that important piece, because when we go back a couple of slides, if I can figure out my way back, there we go. Remember, the IRS defines virtual currency as basically a representation of value, looks and smells and sounds a lot like currency, right? But they don't want you to treat it as currency. They want you to treat it as property. So we'll talk about what that means in a second. In 2019, they came out and they said that if you own crypto that undergoes what is called the hard fork, you've got taxable income if that hard fork results in a new cryptocurrency and you actually or constructively received the cryptocurrency. If that paragraph made your head hurt, I want you to just ignore it. You're probably not dealing with hard forks right now. If you get more and more into crypto, you might. It'll come up at that point. You'll talk to your accountant about it then, but don't stress too much about that right now. In 2020 was really when we saw a shift. The IRS started to recognize that, hold on, a lot of money is being exchanged in these digital currency environments, and we don't really know about it. So 2020 is when they said, we're going to need to know what you've got going on. We need to know if you're investing in it, if you're selling it, if you're trading it, what you're doing. And that's when they introduced a question on the personal income tax return, asking if you did any of those things with virtual currency and putting in place some pretty harsh penalties if you incorrectly answer that question. So we're now in our second year of tax returns where we've had that question. If you're a client of mine, you know that that's a question we ask in our organizer. It's really important we answer that question correctly, because if they find out in the future that you answered it incorrectly, the penalties can be pretty harsh. Now, in 2021, so just last year, they decided that they didn't just want you to answer the question about this on your tax return because, spoiler alert, a lot of people might lie. Or if we assume the best about people, a lot of people just might get confused by the question or might not realize they have to answer it, or just they're not sure about it. So what the IRS decided to do is they said, well, we want a formal reporting structure in place for this. And they went to the government, they went to Congress, and they said, we need to put something in place. This was part of President Biden's massive bill that was passed last year, which is going to require, starting in 2022, so starting this year, is going to require that crypto exchanges or digital currency exchanges report any transactions that happen through what's called Form 1099-B. So right now, if you own stocks in the stock market and those get sold or bought or sold, those get reported on Form 1099-B. So starting in 2022, they're going to require that any of your digital currency transactions also are going to get reported on that Form 1099-B. And that's a form that you have to put on your tax return. You have to put that information on there. So it's going to be really interesting to watch for a couple of reasons. Number one, because we're going to see a lot more of these transactions actually being reported when they weren't probably reported in the past. But number two, we're also now seeing some level of, it's not necessarily regulation, it's reporting, but it's still kind of that formality of it, that these digital currency landscapes or digital currency platforms just weren't used to before. They didn't have before. And so it'll be really interesting to see how this all goes down and if there are still issues with reporting after 2022. So just keep that in mind, that if you have digital currency, if you own digital currencies and you do any kind of trading with them that is in theory a taxable event, which we'll talk about in a second, you're probably going to get a Form 1099-B starting in the 2022 tax year. So you'll get it next year, 2023, when you get your forms for this year. Okay, so this is the part that people really care about, is like, okay, cool. You said all these like big things and words that I don't understand, but what does that actually mean? Like, am I actually going to pay tax on this stuff? What's going on here? So I'm going to run through a bunch of scenarios. I think this covers most of the things that people, are doing or care about. But again, let me know in the chat if there's anything in particular. I'll do my best to answer it. I'll probably say this a few more times while we're here. There's not a lot of guidance on this stuff yet. The IRS, as you saw, didn't even come out with their first guidance until 5 years after Bitcoin existed for the first time. So they're very behind, and they're I would argue probably a little out of their element when it comes to this stuff, because this is a new concept. This is a new type of exchanging things of value. And so I think it's going to be a while before we have any real concrete guidance on this stuff that frankly doesn't make our heads hurt. But nonetheless, we're going to run through these scenarios to try to at least make some sense of this stuff. So the first scenario is, let's say you buy some form of virtual currency with US dollars. So you put US dollars into like a Robinhood or some other platform, and then you buy some virtual currency with it. Maybe you buy crypto. Maybe you buy Bitcoin, okay? And you keep that investment within the same exchange where you made the purchases. So you can maybe trade with it, but it stays within that same exchange. As long as it stays within that same exchange, it's most likely not taxable, okay? And this is where I think a lot of people are going to get confused, because when you put money, for example, I'm going to use my Robinhood account as an example. When I put money into my Robinhood account and then I go buy a bunch of stocks, if I sell those stocks and buy other stocks, those are taxable events. And I'm going to pay tax on any gains I got from selling those stocks, even though I didn't take the money out and put it back in my bank account. I just rerouted it to another investment I bought. But in those cases, that's taxable. But when we have like crypto, for example, as long as it stays within the same exchange, it's typically not going to be taxable. Now, let's say you actually do sell, I'm using crypto as an example, but this can be any digital currency. Let's say you actually do sell, and of course my dogs are going to start barking right now. Let's say you actually do sell, hold on, let me close the door. My dogs get very unhappy whenever packages are delivered. Okay, so let's say you actually do sell your crypto and you get US dollars back. So now you actually have your money back. That's a pretty easy one. You're going to be taxed on that if you have gains. So if you put $100 in and bought some crypto and you get $150 back, you've got a $50 gain, you're going to pay tax on it. Easy peasy. There's no question on that one. Whether it's taxed, and it's going to be taxed as capital gains. This is like, remember I said, it's an important point that they're not treating virtual currency as currency. They're treating it as property. This is why, because by treating it as property, it's going to be subject to the capital gains tax rates, which isn't necessarily a bad thing. That's a good thing, actually. Your capital gains tax rates, if it's a short-term gain, meaning you've owned the investment, whatever it is, less than a year, are just your ordinary income tax rate. So whatever income tax rates your other income is taxed at, the 12 or 15 or 25 or 28 or 32 or 36, I think I got them all right. Whatever those percentages are, that's what you're going to be taxed at if you've owned it less than a year. If you've owned it more than a year, great news. It's the long-term capital gains tax rates, which are 0, what are they? 0, 15, and 20%. That sounds wrong to me for some reason, but no, I think that's right. 0, 15, or 20, 0, 12, or 15. Now I'm confusing myself because it's late in the day. But the rates are a lot lower, and it depends on how much gains you have, what rate applies, but the rates are a lot lower. So that's great news. Okay, cool. It's going to be long-term capital gains. We like that. That's a good thing. Now, let's say you exchange your crypto for another investment. So you don't get US dollars back, but you do take it out of the particular exchange. So if you've got Ethereum and then you buy Bitcoin, for example, in this case, it's going to be a taxable event because you're not sort of trading, Bitcoin for Bitcoin type thing. Okay. So, and again, these are taxed at capital gains rates. The short-term rates are your ordinary income tax rates. The long-term rates are the lower capital gains tax rates. Now, let's say you decide to use some virtual currency to mint an NFT. Very fancy phrase there, which didn't mean a whole lot to me until a few months ago when I started learning about this stuff. So if you're new to this, we talked about what an NFT is. It's a non-fungible token. It's basically a representation of value of a piece of digital art or some kind of digital collectible. So you use some virtual currency to mint an NFT. So what happens in this case? Well, you're going to pay taxes on the gain on the virtual currency because, again, you had virtual currency in some form over here, and now you're using it to create an NFT. So you're sort of pulling it out of its original location. That's a taxable event. You're going to pay tax on that. If you're not minting the NFTs for business, so if you're just doing this for fun, for personal purposes, the gains become capital, or the gains are capital gains. If you are doing it for business, so for example, a lot of like artists in particular are minting NFTs as part of their business. In that case, any gains you have will be ordinary income, again, subject to the tax rates of your business if it's a C corporation, or your individual tax rates if it's an S corporation or partnership or a single member LLC or sole proprietorship. However, the good news is, if you are doing this as part of your business, you can deduct expenses incurred in minting that NFT if you are creating it as part of your business. You don't get to deduct those expenses if you're just doing it for fun. And again, any questions, put them in the chat. Happy to answer those as I go along. Now, let's say same scenario we just had, but now you go ahead and you actually sell the NFT. So you've made this piece of digital art. You're going to go ahead and sell it to somebody. Somebody comes in and buys it. Again, this is a taxable event, much like it would be if you were selling a physical piece of artwork, right? You'll pay tax on those gains, but you can also you can also get a taxable loss that can help offset other income if you lose money. So if all in told, the value of what you put into this NFT was, let's say, $500 and you sold it for $300, that's a loss. You get $200 loss to use against other income to offset that other income. On the flip side, if you paid $500 to mint this NFT and you sold it for $1,000, you'll have a $500 taxable gain. And again, if it's business, if it's related to your business, that taxable gain is going to be taxed at ordinary income tax rates or business tax rates, depending on the form of your business. If it's personal, they'll be taxed at those capital gains rates. Okay, so let's say you have a business and you actually receive crypto as payment for a product or service that you provided. A lot of businesses are doing this now, that they're allowing folks to pay them in currency other than US dollars. Well, in this case, because you're a business, that's taxable income. Anytime we get paid in our business for a product or for a service that we provide, that's going to be taxable income. Now, you can deduct your expenses related to creating or providing that service or product, But any profits you have at the end of the day are going to be subject to tax. And again, they'll be subject to either the business income tax rates if you are a C corporation, or the ordinary income tax rates, individual income tax rates, if you are a partnership, an S corporation, a sole proprietor, or a single member LLC. When we think about that gain as well, this is an important point I want to mention, because now one of the questions that comes up a lot with my folks is they'll say, okay, well, how do I actually calculate that gain? And what we do, what the IRS has told us to do at this point is to calculate it based on the fair market value of that currency in US dollars. So remember a few slides ago, I said that at one point, Bitcoin was worth 60K, and at another point it was worth 30K US dollars. Whenever we're trying to calculate the gain on a transaction, we're going to look at whatever the coin is that we have, whatever the virtual currency is. We're going to look at the fair market value, the US dollar value of that currency on, at that moment when we put it in, or at that moment when we sell it, depending on what we're trying to calculate. So, one really important benefit, it's a tax special like loophole in the tax code, not even loophole, it's intentional, but it's in the tax code that's really great, is if you are selling NFTs that are art-based, so a photograph or a painting or anything like that, and again, these are all digital, those NFTs will likely qualify as what we call collectibles. So the IRS has special tax rates for collectibles. This is a special tax benefit that a lot of artists take advantage of because their work squarely falls into this category. But if your NFTs qualify as collectibles, any gains on those NFTs will be taxed at the capital gains tax rates instead of those ordinary income tax rates like we were talking about before. So that's great news. So if you are in business and you are making collectibles, art to sell, they are taxed as collectibles. You get to save a little bit of money, which is nice. I mentioned these, I mentioned these very quickly before, but these are the capital gains tax rate, 0, 15, and 20. I was right the first time, that's what I thought. These are the capital gains tax rates. So in the event that whatever it is you're selling isn't part of your business, it's just being done personally, or it is part of your business, but it's treated as a collectible, you would be subject to the capital gains tax rates. And so the way we calculate this, and again, this is very similar to if we had something that wasn't digital, is we take the amount we earned for the sale minus the amount we spent when we bought it. That's our capital gain or loss. If it was owned less than a year, it's taxed at those ordinary tax rates, 0 to 38%. If it's owned longer than a year, we do the long-term capital gains tax rates, which are here in that little box. So if you're single, the 0% rate counts up to just under 42K. The 20% rate doesn't kick in until you hit 460K. So the rates are pretty favorable. They're much more favorable than the ordinary income tax rates that apply to our regular earned income. Now, I don't know about you, but this all feels really hard to me. I think one of the biggest challenges when we own virtual currency is just figuring out, is this a taxable event? And then what is the gain if it is a taxable event, and how to track it all? And this is overwhelming even to me, an accountant who, spends my time. It's literally my job to understand this stuff and to become well-versed in this. So I highly recommend, if you're not already working with a tax professional who understands virtual currencies, it's really critical that that last piece is true, that they get this stuff. Because and frankly, this is the case about anything in the tax world, is you want to work with someone who understands the things that apply to your business. I cannot tell you how many times I've had prospective clients come to me and a former, accountant, former tax preparer has messed something up because they just don't understand that component of their business. The tax code is really, really big. I mean, it's literally, if we put it into books, it would be lots of books, lots of like really big books. So it's impossible for every CPA to understand everything about the tax code. There are definitely areas of the tax code that I do, they're not my thing. They're not relevant to my clients or my business. So I'm not well versed on them. And so it's really important that you find a CPA who understands this stuff, is staying on top of this stuff, and frankly is in it. One of the things that I was talking with a client the other day, and we were talking about this. He has a lot of investments in crypto and some other stuff as well. And he said, I really appreciate that you not only understand this stuff as a CPA, but you're also invested in this stuff. So, I was able to share with him some of my own experiences and talk through some of that stuff. And then that helps me understand the nuances of this. It's not required that your CPA, always be doing the same things you're doing. But I think it can help, especially with an area like this that is so new, so misunderstood, just very confusing for a lot of folks. I also highly recommend, and this is always the rule for everything tax related, but especially for virtual currency, that you keep really good records. Again, because this is an ever evolving area and because the IRS is putting a lot of scrutiny on this, which is sort of ironic given that they haven't given a lot of guidance on it, but they know it's an abused area. They know there is a lot of money being made that's not being reported. It's really important that you keep good records so that if you do get audited, or even just if you're trying to fill out your tax forms, you've got all of that information that you need. So keeping any statements that come from the exchanges that you're on, just keeping a record of what actions you take, when you're putting money in, when you're moving money around, when money is coming out, is going to be really critical for this. I also highly recommend if you are trading, so, not just sticking some money in and let's see what happens to it, but if you're actually trading, I would use an online platform that is designed to track your transactions. There are several out there. I've put the names here. So cointracker.io, tokentax.co, or cryptotrader.tax are all really good at, essentially what they do is they track every movement you make in the virtual currency world. And then they spit out a report at the end of the year saying, okay, this is what's taxable. This is not, these are your gains. Really, really critical to use a tool like this if you are actually doing anything in the virtual currency world, because at least up to this point, the information that, as far as I've seen in your, investment platforms, doesn't necessarily do a good job of, one, giving you the basic information you need, and two, correctly identifying if something is a taxable event or not. So these online tools that I mentioned here will do a much better job of that. Also keep in mind that if you are making taxable income, if you're earning income on these transactions, you may have to pay quarterly estimated taxes. Now, I think most of the folks who are going to be watching this are probably already thinking about quarterly estimated taxes because you have a business. And so you've just already got it in your head to make that a part of what you do. But, regardless, if you are already doing quarterly taxes, you need to start thinking about, how do my digital currency transactions affect that, and layer those on. And if you weren't already paying quarterly taxes, thinking about, okay, am I making money on these digital currency transactions, and do I need to layer those in? And how is that going to affect what I actually owe? So at the end of the day, the honest truth is that everything I told you today could be different tomorrow. This is an ever-changing environment, and we are constantly learning new things. We are constantly getting more guidance on this. Again, going back to the fact that the IRS took 5 years before they issued a single piece of guidance on virtual transactions, really, should be evidence of how behind they are on this. They're trying to figure it out. We're all trying to figure it out. We're trying to do our best for our clients to help you understand what your obligations are at this point. But I think we're going to see just constantly new and evolving regulations on this stuff. And everything I told you today, by the way, is at the federal level. I think we're also going to see differences in reporting requirements and maybe differences in taxation at the state level as well. The states tend to be pretty behind the federal government. We've seen this especially in the sales tax area, where a lot of states still don't have the concept of digital products when they talk about sales tax. And so I think we're going to see them be behind on this issue. But that said, this is an area where we know people are making a lot of money, and we know they're probably not paying taxes on it. And a lot of states need money right now, especially after the pandemic. So it wouldn't surprise me if we're seeing states be more diligent about virtual currency and coming up with more rules around it, more reporting requirements, and more taxes around it as well. So it's something that you need to stay really attuned to. And if you are engaging in these types of transactions, again, I just cannot stress enough, keeping those good records, having a system that tracks it, like Token Trader or crypto tax. So that when you get to the end of the year or your quarter where you're going to do your quarterly estimates, you've got the information you need to be able to do the right thing, basically to do the right thing at that moment, because that right thing might change every moment as we get more guidance on this stuff. So, okay, my friends, that is all I have for you. I know we wrapped that up a little bit early, but I thought that probably talking about this for an hour might make everyone's heads hurt. So I'm going to leave it there. I want to give a few minutes for questions. I know we've got a few people on the Zoom with us. We've also got several folks watching over here on YouTube. So I just want to give it a few minutes before I officially shut off in case folks have questions. So I'm going to just sit here. I'm going to drink some tea and I'll give you a minute. Let me know if you've got questions in the chat. Let me check over here on YouTube. Oh, wait, hold on. Let me pull up my thing over here so I can see. Apologies to my YouTube folks. I just accidentally lost you. So if you've asked me a question, I'm getting back there. Give me a second. Okay, so I'm not seeing any questions. So I'm going to go ahead and let me just check YouTube real fast. Okay, so I'm not seeing any questions over here on YouTube either. I'm going to go ahead and wrap this up. Thank you for everyone who is here. Hopefully this was helpful. I know this can be a really confusing topic. Bottom line, just take a deep breath, keep good records, talk to your accountant, use one of those tools to track the activity that you're doing and give you that tax report, and just, be listening for the changes that are coming, because we know we're going to get more and more guidance as this thing goes along. So thanks everyone for being here. For all of my members who are going to be at our money meeting next week, I will see you then. Have a great